Good afternoon, everyone, and welcome to the RealNext webinar series. Today we'll be talking about Introduction to Real Estate Investment, and today we have Dr. Jeffrey Fisher, who will show us how to run uh, various analyses using the Market Edge program within RealNext. Dr. Fisher is the head of data and research for RealNext, board member and professor emeritus from Indiana University Kelley School of Business, president of the Homer Hoyt Institute, and co-author of Real Estate Finance and Investments and Income Property Valuation. Certainly an expert in the field of real estate investment analysis. We're delighted to have you with us, Jeff, and share with us how we should approach that, how we should be thinking about um, underwriting real estate and using Market Edge to come up with pricing and helping in decision making for people as they go to market with investment sales or they're looking to buy property today. As always, we are recording the session and we'll be distributing it after so that you can replay. And if you have questions along the way, please chime in using the question feature in GoToWebinar, and we'll do our best to address the questions along the way. Jeff, I will let you take it away.
Okay, thanks, Jeff. One of my favorite topics to talk about. I assume you can see my screen okay now. So again, we'll be talking about Introduction to Investment Analysis with RealNext Market Edge. Now, to start off with the concepts that are applicable no matter how you're doing in the investment analysis, whether you're using Market Edge or some other software program or a spreadsheet, but then we'll look at how you can put those inputs into Market Edge and do your analysis. I use an example, fairly simple example, but it gets across the concepts that actually I also have in my textbook, Real Estate Finance and Investments. I'll show you how you can download the file that goes with that example right into Market Edge and get the same solution that I'll be going through today. For some reason, my down arrow wasn't taking me to the next screen. So if you remember the movie Jerry Maguire, the line, "Show me the money," which I think is something to keep in mind as you do any type of what we call discounted cash flow analysis, whether it's doing an investment analysis or solving for the value of the property. Keep in mind that it's the cash flows that matter. And I think a lot of times that can get you out of trouble if you just think, okay, what really matters is how much cash am I going to get each year? How much cash am I going to get when I sell the property? And then we convert those cash flows into a present value. Not sure why my down arrow is not working like it should be. Here we go. Okay. So we're going to review the concepts behind lease by lease discounted cash flow analysis. Lease by lease means we can take into consideration each of the leases on the property. The concepts will be the same in all lease by lease programs. So again, as I said, it applies to RealNext Market Edge, or if you're using Argus or even Excel to do the analysis. It applies to both investment analysis and valuation. Those are really kind of flip sides of the same coin. And with investment analysis, we start off with the purchase price and we say what kind of rate of return would I get on this property if I hold it for a certain number of years and then sell it at the end of some holding period. With valuation, we just turn that around and we say, what purchase price would somebody pay in order to get a rate of return that investors typically require in the market? So instead of solving for the return, we start with the return and in a sense work backwards to get the purchase price. And we call that the value. If it's the typical investor that we're looking at and the rate of return a typical investor would want, then it would be a market value. But we could also make assumptions that are what we think is going to happen in the market that may be different than the typical investor. And that would be more of what we call an investment value for the property. Then we'll go through an example, as I said, using Market Edge in order to solve for the return. And actually, we'll also get the value of the property. And we're going to do it for a sample office building investment. And again, I'm taking an example that's from the Real Estate Finance and Investments textbook, 17th edition, Brueggemann and Fisher. So what I'm going to do in several slides is go through the basic ingredients, as I call it, of any discounted cash flow analysis. I want to get you thinking about what are the kind of inputs you would need in order to do an investment analysis or evaluation when you're using this kind of a program. So first of all, you got to think about a holding period. And what I almost always see, especially with the institutional investors that I work with, but having worked with people using different programs over the years and working with appraisers and investors, typically they assume 10 years. That doesn't mean they really plan to hold the property for 10 years, but it's sort of a typical time period. In a sense, it doesn't really matter as long as you estimate a resale price that reflects what's going to happen after you sell the property. And what we're really doing is just trying to say, how long can I reasonably project what the leases are going to look like? And then at some point, I just say, okay, I'm going to now estimate a sale price of the property, which reflects what's going to happen after that, but I'm not going to try to actually project detailed leases beyond that period. We usually want to go long enough that any existing leases have rolled over to market rents. You might have existing leases on a property that are below market or above market, and it just makes it easier to estimate the resale price of the property, and we'll talk about how you do that, but it makes it a little bit easier or more accurate estimating the resale price if your leases are at market rents at the time you're assuming you're going to sell the property. And by the time you've gone out 10 years, typically any leases have rolled over to market. We also need to project the income from existing leases before they roll over to market. Now, we'll also have to make some assumptions about what happens when those leases are renewed, but start off with, we need to project the income from those existing leases. So we're going to look at what the current rent is. Oftentimes you can input that a lot of different ways, whether it's on a per square foot basis or some per unit basis, like on an apartment building, you might look at rent per unit. There may be some fixed steps in the leases that you have to take into consideration, that it's going to increase by so many dollars per square foot after a certain number of years. We used to have CPI adjustments in leases. Even with inflation coming back, it doesn't seem like I'm still seeing that yet. Used to be pretty common in leases where you'd have an increase in rent based on whatever happened to the CPI. Usually it was a percentage of the CPI. Like if CPI went up 1%, the rent would go up by half of that, or a 0.5%. There could also be contingent income on properties, like percentage rents on retail properties that's based on the sales of the tenant. And what's really going to be important to capture is expense reimbursements, where a lot of times you can get reimbursed for the expenses after they've increased by a certain amount. There's different ways that that's done, which is one of the things that makes discounted cash flow analysis probably the most complicated, is really trying to capture the way the expense reimbursements work for all the different leases. We'll give you an example of how that works as we look at the example later on. There could be other income in addition to your lease income: vending, laundry, telecommunications, parking. So we need to also take that into consideration. Then when those leases come up for renewal, we have to ask ourselves, are there any renewal options in the existing leases? What will be market rents when those leases come up for renewal? Different ways that tends to be done in programs and spreadsheets. A lot of times it's thought of as a weighted average of what might be paid on new tenants. If a new tenant comes in and leases that space versus a renewal of an existing tenant. For example, a new tenant might be paying $15 per square foot, but an existing tenant, if they'll renew their lease, you might only be charging them $14 per square foot. Why a difference? Well, if I'm able to have an existing tenant renew their lease, I'm not going to necessarily have leasing commissions, or maybe not as high a leasing commission. I may not have to spend any additional money on capital expenditures that I would have to with a new tenant to fix out their space the way they want it. And I may not have any, or should not have any downtime. Whereas if we have to get a new tenant, it might take some time for that space to be leased and that tenant to move in and start paying rent. So in this example, the idea would be if it's $15 for an existing tenant, $14 for a renewal tenant, we just take a weighted average of those two based on some probability. Like we think the renewal probability is 75%. So there's a 75% chance we're going to get $15, 25% chance we're going to get 14. And that gives us a weighted average of $14.25. So will there be additional TIs when the leases roll? So again, we have to take into consideration that there may be a renewal or it may be a new tenant. So again, that's usually done as a weighted average. We usually put in what the TIs would be for a new tenant versus a renewal tenant. Same idea with leasing commissions, and then same idea with vacancy. It'd be like saying, well, if I don't get a renewal and I got to get a new tenant, there's going to be so much vacancy. Weigh that again by the probability that you're not going to have a renewal of the existing tenant, and that would give you the assumption that's going to go into the program for your vacancy rate. You wouldn't have to actually do these weighted average calculations yourself. The program will usually do that for you. In RealNext, we kind of simplify a little bit and assume that you're putting in a rent that reflects that could be a new or renewal tenant. Also have to ask yourself if there's space that's currently vacant. So that would be space that is going to be leased up, or at least you can assume it is going to be leased up. I suppose there could be situations where you don't think it's going to lease up at all, but if it is going to be leased up, you would have to make an assumption about how fast it's going to be absorbed, which is just leasing it up, and at what rate it would be absorbed into the market. Then your operating expenses. So when I talk about the operating expenses, we got to be careful we don't mix that up with the reimbursements. Some of these expenses may be reimbursed, but we still have to pay them. We're just going to get reimbursed for them. So here we're going to put in all the expenses, even if some of them are reimbursable, unless they're expenses directly paid by the tenant. But assuming we're paying the expenses and then getting reimbursed somehow for them, we need to include it in the operating expenses. So these would be things like property taxes, insurance, maintenance, marketing. Sometimes you make an assumption whether they're fixed or variable or some combination. Like insurance would be more of a fixed expense. By fixed, we mean it does not vary with the occupancy of the property. Doesn't mean that, and property taxes is probably a better example. Property taxes certainly can change, but they don't vary with the level of occupancy on the property. Whereas, some of the other expenses, marketing and maintenance, at least to some extent, may vary depending on what the occupancy is. Capital expenditures, that's always a tough one. In practice, you tend to see capital expenditures, and maybe I should just clarify what we mean by capital expenditures. So these would be things that aren't normal operating expenses. Replacement of an HVAC, repair of a roof, things that we have to budget for that don't occur every year, may occur every 5 years, every 10 years. But the question is whether we kind of set up a reserve for those capital expenditures. And when we set up a reserve, do we calculate it what's called above the line before we calculate net operating income, or below the line under the net operating income line? And I'll get back to this a little bit more detail when we look at an example, but RealNext allows you to do it either way, because we know in practice capital expenditures are handled a lot of different ways, whether you either set up a reserve and have an amount every year to take into consideration that at some point I'm going to have to spend the money, or to just assume it's going to be spent in the year that you you think you're going to spend the money, which is the way I prefer to do it. Because if I know I'm going to have to replace the roof in 5 years, then I want to project a cash outflow in year 5 to cover that rather than an annual amount. I don't think most people actually set aside money anyway to do those capital expenditures, although some lenders will require you to set up some type of reserve, especially on apartments, and especially if it's some sort of government agency financing. So we have our capital expenditures to project out. Some things that may be optional are like the loan information, and later on I'll mention tax information. We can either do our analysis assuming there's financing and see what our rate of return would be on a leveraged basis, or we can look at it without financing and see what our unlevered rate of return would be, or do it both ways. Start off and say, okay, if I don't finance it, what rate of return can I get? And then if I borrow money, hopefully I'm borrowing at a rate that's below the return that I'm going to get on the property, so that I have positive leverage, and then see how the leverage helps my rate of return. And the leverage also helps you tax wise, since the interest is tax deductible. Right now, actually, leverage is kind of negative or neutral at best on a lot of properties, because interest rates have gone up, and the returns have been kind of low recently, especially if you're looking at it in terms of whether your net operating income is going to cover your mortgage payment. On an IRR basis, where you're looking at the return you're going to get over the whole holding period, you still may be coming out ahead relative to what it's going to cost you on the loan, but it's a little bit tough anymore to cover your cash flows on a lot of properties. So that's a concern I keep hearing in the market. Discount rate is important if we're trying to solve for the value of the property. If we're doing an investment analysis, we're actually solving for the discount rate, rate of return, IRR. They're really all kind of the same concept. It's just your perspective as to whether you're using it as a rate to calculate the present value of the cash flows to get an estimated value of the property, or whether you're solving for it, where we usually call it a return or an internal rate of return. So that can again be unlevered or levered, depending on whether we included a loan in our analysis. Reinvestment rate, the idea there is that we can make an assumption as to how we might reinvest cash flows that are coming in each year. You don't have to do this in an analysis. CCIMs in their courses always talk about calculating returns, where you take into consideration how you can reinvest the cash flows and calculate something called an adjusted or a modified internal rate of return. I've worked with the CCIMs in the past on revising their courses, as well as developing courses for the Appraisal Institute, and both of those organizations cover this concept of an adjusted or modified IRR in their courses. Although I don't, to be honest, see a lot of investors actually worrying about calculating the adjusted rate of return. Usually they're happy to calculate what the IRR would be on the property and compare that with different alternatives for how they could invest their money. But I'll show you how you can put an input into RealNext to calculate the adjusted or modified rate of return. Tax information. So that's also something that's optional. You wouldn't normally see tax information go into an analysis where you're solving for value, but if you're doing an investment analysis, there I think a lot of investors really want to know, what are the tax benefits that I'm going to get from owning this property? Because real estate still has some tax benefits. You can depreciate it. So you'd want to put in whether it's commercial or residential property, what the depreciable life would be. And properties can be depreciated still over a shorter period of time than the time that hopefully they actually become obsolete. So there's some tax benefits there, because that's reducing your taxable income. So it's reducing income that would be taxed at your ordinary income tax rate. When you go to sell the property, some of that is recaptured, some of the gain that you get, because your gain, as we'll see, is the difference between the sale price and your book value in the property. Your book value is going down as you depreciate it. And so when you sell it, if you're selling it for more than that book value, the difference between what you paid for it and the book value, that depreciation that you took each year, is recaptured, which means you have to pay tax at a 25% rate, but that's still, in a lot of cases, will be less than your ordinary income tax rate. So you're still coming out ahead. And then the rest of your gain would be taxed at the lower capital gains tax rate. So you don't need to worry about all those details because the program takes care of that for you. But that's what's going on when you go to sell the property in terms of taxes. And so again, there are some tax benefits. As an example, if you're in a 30% tax bracket and your before tax IRR is 12%, and your after tax IRR, which will be calculated by the program, is 10%, then you see that your return actually only dropped by 2%, I should say by 20%, not 2%, 20%, from 12% down to 10%. So your effective tax rate is only 20%, even though you're in a 30% tax bracket. Okay, last but not least, we need to estimate the resale price of the property at the end of the holding period. You think about whether there's a right of first refusal, where the tenant has a right to buy the property, or somebody has the right to buy the property, that might affect what you think about for the sale price. Typically, though, what you see is estimating the resale price by using the concept of a cap rate. I think probably everybody on the call knows what a cap rate is, although we see in practice cap rates calculated all different ways, and sometimes it's hard to know exactly what cap rate to use and how was it calculated. But nevertheless, what we typically do is take the income that's going to be 1 year after we assume we're going to sell the property. Why 1 year after? Because that's the first year of net operating income to the buyer of the property. And so the idea is, well, what would a typical buyer pay for the property if we're going to sell it? And let's say we're going to sell it in year 10, the buyer's going to be looking at year 11 as their first year of income and say, okay, if I'm willing to buy that property at typically at a 5%, let's say cap rate, divide the net operating income for year 11 by the 5%, and that gives you your estimated resale price. So that's what I typically see done, is just using a terminal cap rate. There's other options that could be used, like assume that whatever the purchase price is going to grow at some percentage every year, or if there is a right of first refusal that you think is going to be exercised, and you know what that price is, you could just use that price. But I'd say 99% of the time, I just see a terminal cap rate used. We call it a terminal cap rate because it's the cap rate used to estimate the resale price, whereas the cap rate that we usually talk about that applies when you're buying the property, we call that a going in cap rate, or simply the cap rate. Jeff, let me know if any questions are coming in. I know some of this is maybe new to some people and maybe gone relatively fast.
Yep, the one question, and it's not on topic, but I'll address it since you brought it up. They're asking about waterfalls. We do not have a waterfall capability yet. It's something in our roadmap to develop, but if you have investors with different return profiles, they will be modeled in a future release, but not currently. There are different debt structures, and you can get some degree of tiers of debt being repaid, but not from on the equity side. And the other, just a reminder to everyone that we are recording and we'll be distributing this.
Yeah, and definitely we've talked a lot about incorporating the waterfall into the program, where you have a preferred return, and then some percentage that's earned once you go above that. So we definitely want to incorporate that into the program. We can, as Jeff kind of mentioned, allow for different loan structures, though. So RealNex Navigator includes the DCF analysis. So you would go to www.realnex.com and log in, And what we're talking about today is using the presentation and property analysis. There's a whole lot of other things you can do, of course, in RealNex Navigator. I don't know if we want to talk about any of these other things, but there's the CRM, and uh, there's listings, and you can search for the different properties, and there's deal rooms and tour book and deal management, and just all kinds of other things that you can do with RealNex Navigator besides the investment analysis. So we're just focusing on that one tab there to the left, the presentation and property analysis. There's also a separate analysis that you can do just on comparing different lease alternatives for a tenant. We're going to incorporate leases, of course, in our investment analysis, but the lease analysis, which is kind of covered up there, but it allows you to compare different lease structures, whether you're going to be the owner or whether you're going to be the tenant, and see which is more favorable to you depending on which you are, whether you're an owner or a tenant. Some similarities between that and the investment analysis, but there we just want to focus on what the value is of the leases, kind of the present value of each of the lease alternatives. You will be able to get the file that I'm using it as an example today. If you go into the share and search the real estate exchange, and you'll see in what's called the academic community two examples. One is Monument Office, which is what I'm going to go through today, and there's also an apartment example. Those are sort of probably the two that have the most differences in terms of the way leases would typically be structured. So having an office example and an apartment example. So I'm going to use the Monument Office as an example. And so I'm going to just talk about some of the different inputs that would go into the analysis. There'll be overlap from what I talked about before, but now we're going to see it being put into the program, and with some actual numbers to talk about. Hopefully it'll help to reinforce, why we need these different inputs. So clearly we need a purchase price if we're doing an investment analysis. If we were solving for the value of the property, we wouldn't necessarily need a purchase price because, as I said, we're trying to solve for the purchase price. We call it a value, but we're really just solving for what purchase price makes sense. But in this case, we're going to put in a purchase price of $12 million. There's other inputs here that are more descriptive in nature that'll be important for creating different reports. I'm kind of focusing in this example on the numbers to calculate the rate of return. So don't even have some of these fields filled out that you would want to fill out if you were doing an analysis of a property, so that when you create a report, a lot of this information can show up in the reports that you create. So we've got a $12 million purchase price. We have an analysis date. So in this case, it was July 2020 that we're looking at buying the property. So we're going to start our investment analysis as of July 2020. The program asks you for the value of the land. It's not really resale information. It's the value of the land today, but it's going to be important for the tax calculations and affect what your taxes are when you do sell the property. So that's why we need to know the value of the land. It wouldn't be important if you weren't doing an after-tax analysis, but if you're doing an after-tax analysis, it's important. Why? Because you can't depreciate the land. You can only depreciate the building. So we need to know how much the land is, so we're sure not to apply the depreciation to the land portion of the value. As I talked about, the way we typically calculate the resale value is to apply a capitalization rate. So here it's 7.75%. We're going to apply that to the net operating income. You notice the checkbox, it says subsequent year, which is checked by default because that's what's typically done. Okay, I explained why it's 1 year after the sale of the property, because that's the first year to the buyer. This example, I didn't include any resale expenses, but typically you'd have some resale expenses associated with sale of the property. So that might be 3% or whatever, 4% as your resale expenses. We've got a federal income tax rate of 35%. You could leave that 0 if you just wanted to do a before tax analysis and didn't care about the taxes. But if you want to have an after-tax rate of return as well as your before-tax rate of return, put in a tax rate as well as your capital gains tax rate, which is typically going to be a lot lower. Remember, some of that gain is going to be recaptured. You don't have to put in what the recapture rate is because the program knows. Okay, hasn't changed for a while, so it'll automatically use that 25% rate to the recapture portion of the gain. So you just need to put in your ordinary income tax rate and your capital gains tax rate. There could be what's called general vacancy. What that means is, aside from the program calculating vacancy when leases come up for renewal, or if you have any space that's vacant when you first are buying the property that needs to be absorbed, you can also say, well, I'm going to assume that for whatever reason, there's always going to be a minimum of 5% vacancy. I don't really like that myself, but a lot of lenders require it. They'll say, look, you may have your property 100% leased, but there's always a chance you're going to lose somebody for whatever reason. So to be conservative, we want you to put in a general vacancy rate. These kind of inputs, again, all programs that I've seen would have all these same inputs. So we hope you use Real DCF to do this, but if you use another program, you're going to see the same inputs for the same reasons that I'm talking about. So you'll see a general vacancy rate and all this other information. We also have our discount rate information. So we're allowing you to put in a discount rate that would apply if there's no loan on the property, and it'll use that in certain cases, even if you have a loan, to calculate a rate of return, or I should say a value as if you don't have any financing. And then we have a leverage discount rate, which should be higher because if you use leverage, you have more risk. So your equity discount rate should be higher than your overall discount rate to reflect the additional risk associated with the equity position in the property. And then I talked about that reinvestment rate. If you want to also see what the adjusted or modified rate of return would be, the idea is that cash flows coming off the property, maybe I can only reinvest those at 5% because I can't take the cash flows and go out and buy another property that's going to earn me 8% or more. So I'm going to be a little bit more conservative on how I can reinvest the cash flows. So there's some arguments for why looking at that adjusted rate of return maybe gives you a better comparison across different properties. I won't try to explain all that in an hour presentation. But as I said, CCIM courses and others emphasize looking at that adjusted rate of return to compare different investment alternatives. Passive activity loss rules has to do with whether you have other taxable income that would be offset by any tax losses you have in when you invest in this particular property. So if you have other properties that have taxable income, you could apply the passive loss rules to it. Otherwise, just say no. Probably in most cases that's not something you need to worry about. If there's a state income tax rate in addition to your federal income tax rate that you want to take into consideration, you can also input that there. Then the other two inputs at the bottom right are just a continuation of those general vacancy rate assumptions. For each year of the holding period, you can put in, or at least the first 4 years, you can put in what the vacancy rate would be, and then for the remaining years. And actually, you notice here, I had 0 in years 1, 2, and 3 because because in this particular example, none of the leases roll over until we get to year 4. And then what I did is assume that some vacancy kicks in year 4 when those first leases start to roll over. Okay, Now we've got our leases on the property. I just kept it with 3 tenants because if you understand how to do 3, you can do 100. It's all the same idea. You can name the tenant and put what their suite is, but more important, how many square feet are they occupying, and what's their base rent. Different ways you can put that in. Like here, it's per square foot per year, but you could put it in as a total amount. You could put it in per square foot per month. A lot of different options. That's why you see those little drop down arrows, pick different options. You can put in the start date and the end date. The lease could start before our analysis date, right? And a lot of times that'll be the case. Maybe most of the time, the leases are already uh, there on the property. In fact, in this case, we had leases that started in 2018, 2019, and then 2020, which is when we're currently analyzing the property. So we've got the start date for each of those leases. So it's going to figure out where rents are as of the current time period. We've got our expiration date on the leases, and that's going to be important because we're going to make assumptions about what happens when those leases come up for renewal. Next 2 slides will go into the details on the escalations and reimbursements and what's going to happen when those leases come up for renewal. So you would just be clicking on those boxes in order to get to the inputs that allow you to provide that information. So for each of those leases, what we're going to do is see, are there expense reimbursements and what do they look like? And excuse me, are there assumptions we need to make about lease renewals? I mentioned before there could be additional income from different sources. So that's what you'd put in the bottom left there where it has miscellaneous income. Okay, so for in this case, for the bank, the lease expires June of 2023. We're going to assume that it could increase after that. Although in this case, I guess we're assuming 0 increase on an annual basis. The expense reimbursements, though, are going to be based on any expenses above $280,000 for that lease, or the way we usually think about it is on a per square foot basis. So that translates into $4 per square foot. So the idea is that once expenses exceed $4 per square foot, this tenant has 70,000 square feet. So anything above $4 per square foot, which is $280,000, but you can put in the program, there's a little calculator thing there you see. You could actually put in the $4 and it'll calculate out that for this 70,000 square foot tenant, that translates into 280,000. So the idea being the owner is going to pay up to $4 per square foot. Typically, that would be what the expenses per square foot are at the time the lease is signed. So it'd be like saying, okay, owner, I'll pay the expenses based on what they currently are per square foot, but anything above the $4 per square foot current expenses, I'm going to pass through to you as a tenant. So I'm shifting that risk of any increase in the expenses to the tenant. Of course, this is all negotiable, and there could also be a cap on that. So that once it reaches, say, $7 a square foot, I can't pass through anymore. But in this example, we're going to pass through anything above the $4 per square foot. So you would have that for each of the tenants. You also have your assumptions about what's going to happen when the lease comes up for renewal. And so here what we're assuming is that bank lease goes for 5 years, and once that lease renews, the new market rent is going to be $2.75 higher than what the rent was on the old lease. So that $2.75 there that we see is the expected increase when the lease comes up for renewal. So what we're doing is we're estimating what market rents are going to be at the time the lease is going to renew. There's different ways this might be done in different programs. Sometimes there's a growth rate that you assume that's going to apply to what the rents are today that would take you up to a $2.75, in this case, increase. In RealNext, we just have you put in what you think the increase is going to be when that lease comes up for renewal, and then that'll be added on to the existing rent to get what the rent will be on the new lease. We could also have steps in that new lease. In this case, we don't. The idea is that, you know, the rents are going to jump up by the $2.75, and then they're going to level off again. Okay, financing. So there are a lot of assumptions you can make about the financing. We've got initial equity here, based on having an $8,400,000 loan. The equity, if we take the purchase price minus the loan amount, our equity is $3,600,000. The program will calculate that for you. If you didn't put the right number in there, it'll let you know. And one of the reasons we want to keep that equity in mind is when we do add waterfalls, and want to take into consideration how much equity different people put in, and be able to calculate the returns for different joint venture partners, general partner and limited partners. The funded reserves has to do with whether you want to get a loan to cover your capital expenditures in the future. Don't see that often. More so, it's just your regular financing you're getting on the property. You can see there's loan 1, loan 2, loan 3, so we allow up to 3 loans. So we're talking about loan 1 here, which is fixed rate, $8,400,000, 20-year amortization, monthly payments at an interest rate of 4.250%. And the program calculates what your monthly payment then will be on that loan. You could also put in some closing costs, and you could put in some points if you want to. So, and again, you can also have a loan 2 and a loan 3 on the property. Of course, if you have more of a loan, you have less equity. If there's positive leverage on each of those, you're going to get an even higher rate of return. All right, so that's your financing inputs. Then we talked about the expenses that you need to put in the expenses, even if you're going to have some of those reimbursed. So, and for each of the expenses, you would indicate if they're reimbursable or not. So, for example, the property management is oftentimes not reimbursable. That's usually a percentage of effective gross income on the property. And so here we have property management fee of 5%, and we're saying it's not reimbursable. You could make it reimbursable, just that typically, at least a lot of times I've seen that that's not reimbursable, where you can get reimbursed for any increases in the property management fee. There could also be some replacement reserves, as I talked about before, in addition to projecting out actual capital expenditures. Then you see the different expenses. So here we have property taxes, insurance, utilities, janitorial, maintenance, handyman. There's a whole list of expenses you can choose from, and you can rename any of these to any name that you want. So you're not stuck with the names here. We kind of suggest that you stick with the names that we chose, because you can put all this information in your database and save that and compare across different properties. And so the more standardized the expense names are, the more usable they'll be for other purposes in the future, in doing comparisons across different properties and keeping track of this information in your database. So again, each of those expenses, you can indicate whether they're reimbursable or not. So in this case, our property taxes, our insurance, our utilities, janitorial, maintenance, handyman, all that is reimbursable, which again means if when we add those up, it goes above the amount per square foot that we can pass through to that tenant, we're going to get reimbursed for the increase. Okay. So once we've put all that information in, what does it all look like? Okay, so And even if you didn't follow maybe all the different inputs, a lot of times what you'll see is this analysis that maybe somebody else did, and you're trying to interpret it, right? So wherever it was done, whatever program it was done in, whether a spreadsheet or some other program, you're probably going to see some cash flow projections on the property that look something like this. The naming may vary a little bit from program to program, although I don't think too much. You've got your gross income that you can get on the property if every space is leased, and then you've got to subtract from that the vacancy rate. So you can see here, I assume vacancy kicks in years 4 and 5 when we have some leases come up for renewal. If we had a general vacancy rate, as a lot of lenders require, you'd still have some vacancy showing up in years 1, 2, and 3. We're going to subtract the operating expenses. That gives us something called net operating income, or NOI. I'm sure we're all familiar with the concept of net operating income. Then we've got our loan payments if we had a loan on the property. That gives us something called before tax cash flow. The before tax cash flow divided by the equity that went into the property is called a cash on cash return, because the before tax cash flow is cash we're getting after the loan payment, and equity is the cash that we put into the property. Remember the equity from the previous page. So take our before tax cash flow, divide by our equity. We're getting a 7.7% cash on cash return. That's what I was referring to earlier as getting tough to have today, with interest rates having gone up relative to how much net operating income has increased on properties, especially office properties, right? We're not able to get the positive cash flow after the loan payment. We may still have a positive rate of return when we sell the property, hoping things turn around and after 5 or 10 years, but covering the loan payment is becoming more difficult. Then our tax calculations, you notice we start with net operating income, but we can subtract our depreciation, we can subtract our interest, and that gives us taxable income that we apply our tax rate to get our after-tax cash flow. And we can also look at our cash on cash return on an after-tax basis, a little bit lower, in this case 4.79%. So here's some more detail on the operating data each year. We've got rental income. So we're starting off with our rental income. And remember, we have expense reimbursements that are added back to that. So we add back our expense reimbursements. That gives us our gross scheduled income, which is what we started with on the previous one. But remember, the reimbursements are like additional rental income. It's just that you're getting it from the reimbursement of those expenses. Then we again have our vacancy rate. That gives us our, then we subtract that gives us our gross operating income, but then we subtract our expenses, which in this case for the first year is $497,125. And that gives us again our net operating income, $901,375. We've got our expense ratio there, 35.55%. It's always good to make sure the expense ratio is in line with what you're seeing for other properties and different reports you can get from different organizations on what typical expense ratios are. Okay, resale analysis. So this may be a little confusing when we first look at it. Most programs, I'm not a big fan of this myself, but most programs calculate the sale price as if you sold it in year 1. Then what if you sold it in year 2? What if you sold it in year 3? What if you sold it in year 4? What if you sold it in year 5? I guess the reason I'm not a big fan of this is usually you can only put in one terminal cap rate that you use to estimate your resale price, and there's no reason to think the terminal cap rate would be the same that we would use if we sold it a year from now versus if we sold it, say, 5 years from now. Maybe to elaborate a little bit on that, since I went down that road, is the terminal cap rate usually starts off with what are cap rates today, but then I'm trying to come up with a cap rate to estimate a sale price 10 years in the future. Here we're just using 5 years to keep it simple, but 10 years in the future, and what are interest rates going to be 10 years in the future, which impacts cap rates, and am I able to get the same growth in net operating income 10 years from now? Maybe more, maybe less because the property is older. So there's a lot of things that go into thinking about what the terminal cap rate should be. And typically that would be a little bit lower in year 10 than it would be in year 5 or than in year 1. In any case, what you see here is what the net resale proceeds would be if you sold it in any of these years. Obviously, you can only sell it once, but you see the analysis as if you had sold it in each of these years. We're going to focus in on year 5, though, when we talk about some of these results. So here you see what we call an investment return analysis. So you see the cash flow each of those years. You see the net resale proceeds, like we talked about in the previous chart, the amount of capital that you invested initially, that was your equity capital, net return on the investment. The next one, the label says PV of NOI plus reversion. Probably should just call that the estimated value of the property, because that's really what a lot of programs like an Argus highlight on the main page of the program is the estimated value of the property, which is just the present value of your income that you're going to get, your net operating income, and your resale price discounted at whatever discount rate you put in. So like if we look at year 5 there, the 12,383,000 rounded, that's what you would report as the market value of the property. That's the value today if we sell it in year 5. Okay, so even though it's under year 5, it's the present value today, assuming we got the cash flows that we talked about, or I should say the net operating income that we got for the 5 years, and we sold it at the end of year 5 based on that sale price in the previous page that we looked at. So based on a 14% discount rate, if that's typical rate that investors want in the market at that time, be lower today, but based on a 14% discount rate, somebody would pay today $12,383,000 for the property. Or if they bought it at our purchase price, which was lower than the 12 million, right? We get a rate of return of 12.88%. So that's our IRR over the 5 years. If we buy it and sell it after the 5 years, the modified rate of return, which was, remember, where we have reinvestment of some of the cash flows, that's a little bit lower because we're reinvesting our cash flows at a lower rate, not much lower, 12.32%. The 132,642 says that if we only wanted a 12% rate of return, we could have paid $132,642 more for the property. If we went back and looked at our inputs, we would see that there was a 12% discount rate that was put in for the unlevered rate of return. So the idea is that if we only wanted 12%, based on purchase price that we had for this property, we could have actually paid $132,600 more for the property. All right. Some other summary measures that are really important: the implied cap rate for the property each year. So initially it was 7.51%. By the time we get to year 5, it goes up to 8.02%. Gross rent multiplier, so that's our value of the property divided by the gross rent. Same idea with the net income multiplier, the sale of the value of the property each year divided by the net income on the property. Our operating expense ratios, what the values are on a per square foot basis. Some of the loan metrics. We started off with a loan, remember, that was around 70%. By the end of year one, it's down a little bit. By the end of year five, in this case, we've got it down to 54%. Debt service coverage ratio. Lenders are very concerned about what the debt coverage is on a property. Debt coverage ratio is the ratio of your net operating income to your total mortgage payments, your principal and your interest. So we call it debt coverage or debt service coverage ratio. Generally, the kind of a rule of thumb is at least 1.2. So here we're at 1.44, which is good. The idea is if it gets down to 1, then the net operating income is just covering the debt service. So got any lower than that, we'd be in trouble. And then our after-tax cash on cash return that we talked about, and before tax cash on cash return. Oops, okay, pushed the wrong button there. And then we also can look at some details for each individual tenant, like in this case, the bank. What was the rental income that we got from the bank? What are the expense reimbursements that we got from the bank? We can look that on a per square foot basis and so forth. And finally, we got a lot of neat graphs that can be shown. A lot of this can be pulled into reports. You can choose which ones you want to pull into a report. And speaking of reports, Jeff, I guess I went longer than I expected, but we got a little bit of time left. You can say something about the reports.
Absolutely. I can give you a couple of minutes on that, but there were a couple of questions along the way that I wanted to address first. One is, can we handle a portfolio? The Market Edge is not designed to have property by property segmented and rolled up into a portfolio, but just like you saw, you could put all of the leases in one building and you call it building 1, unit 1, and have building 2, unit 1, through 10, whatever, and aggregate all of the different leases from a portfolio under the analysis, as well as the multiple buildings expenses. So you would just itemize them under, as if they were one property, but it's one portfolio, and be able to show it that way. It wouldn't show individual values of each component buildings, but it would show the value and give you the same analysis across the portfolio. The other was about growth rates, and this is where the expertise of you comes in. A lot of what Jeff showed was how we can do the calculations, but the real value in the calculations comes from the assumptions that you put into it. What is the growth rate? If it's baked into the lease and it says 2% per year, that's simple. You put that in. But if it says a CPI adjustment or other, there's some estimating that needs to be done by you and your expertise. If there are leases that are going to roll over and they're going to take a period of time to lease up, that's where your expertise comes in, that you have to understand your market well enough to know that it's going to take 3 months to lease up or 3 years to lease up. And it's going to cost a certain amount of TI, and it's going to cost a certain amount of commission, and it's going to have some free rent, whatever it is. So those variables are where market expertise of an advisor and a great broker comes in to really help the investment decision making and the investment analysis. So Jeff, I don't know if you want to speak a little bit further to that while I'll pull up some.
I think that well said. That's and appraisers, right? I mean, and I haven't seen the so-called automated valuation models get to the point with commercial real estate where they can really substitute for the appraisal or certainly the role of the broker in the transaction. So we can't ask ChatGPT to tell us what the assumptions should be in our investment analysis. Maybe someday, who knows? But in fact, ChatGPT is only has information up to about 2 years ago when it was trained. So even those artificial intelligence programs that we hear so much about today aren't really going to help us to get current assumptions that should go into a discounted cash flow analysis. So that's why you all get paid to do it.
So one of the things that where Jeff left in the presentation was what can you do with all this information now that you have it in the system? You can use it to help in decision making. So as far as an opinion of value, for example, it comes in to help you create a great book where you have property details, information, the overview, pictures, and other information that Jeff sort of skipped over and talked about. But then it gives you a valuation summary based on comparable sales as well as the income analysis that you have. So the analysis comes in and gives you a variety of a range of pricing, and then you can write your narrative around that. You show your comps and bring that in and indicate which properties are superior or inferior, for example, and you can then create a professional presentation to give to your client. One of our agents recently used a BOV, presented it on one property. The client was so impressed that he wanted them to present a BOV on another, and they ended up winning a third project, $100 million listing, because they were so impressed with the professionalism of the BOV. You can use it to create full offering memos where you have similar type of information presented, but much more detailed analyses where you have the investment details and the operating expenses broken down. That APOD report that Jeff talked about, the pro forma summary. So everything, once you have the data in, you can output it in multiple different ways to present and use it to win business and then sell property, or just as a financial analysis, use it just as a tool to help your client understand what they have and help them in understanding maybe they should sell, maybe they shouldn't, but to understand what what's going on in the market and what's happening with the different tenants and the rollover of tenants, the expectation of leasing, the expectation of value currently or in the future. All these reports are customizable, they're branded for you, the presentations are branded for you. You have the ability to customize certain pages and highlight certain things and add or delete pages that you want and create reports that will work for your clients. So detailed analysis, professionally presented, and used to win business and to close more deals. That's what it's all about. That's what the RealNex Market Edge tool is. So it's not just the analysis, but it's the taking that analysis, putting it into play for you to execute your business more effectively. And our clients are using it well to do that. Let's see if we have any other questions. I think there are a number of notes, but I think we've covered those through the wrap up that we've just had. So thank you, Jeff. Thank you, everybody, for attending. We appreciate it and look forward to working with you to put our investment analysis tools and presentation tools to work, and to seeing you at future RealNex webinar sessions. Thanks, everybody. Bye-bye.
Bye.